Today's session on the ASX 200 was shaped not by what happened, but by what is expected to happen Tuesday at 2:30 p.m. The Reserve Bank of Australia is widely forecast to raise the official cash rate by 25 basis points to 4.35%, its third hike this year, and the market spent Monday priced for pain. The S&P ASX 200 closed down 32.7 points, or 0.38%, at 8,697.1. 7 of 11 sectors finished in the red. Consumer staples led the declines, falling 2.6%, followed by energy, which shed 2.1%. The damage was concentrated, not broad, and that concentration tells the real story. Consumer-facing stocks took the sharpest hits. Coles fell 3.9% despite last week's solid quarterly sales result. Jarden downgraded it, cutting the price target to $21.60. Endeavour Group dropped 3.8% after flagging an extra $6 to $8 million in fuel and freight costs tied to the Iran conflict, plus a $400 million inventory build to manage supply risk. Ingham's fell 4.4% on a new CFO appointment that spooked the market. The IDP education sell-off reached 4.9% as a third major institutional holder dropped below the 5% threshold. Energy stocks followed Brent crude lower. Woodside Energy lost 3.1%. Viva Energy gave up 3.2%. The Geelong refinery remains below full capacity following last month's fire, with a return to 90% not expected until June. Karoon Energy fell 4.1%. There were pockets of strength. Information technology advanced 1%, writing the Nasdaq's seventh record close in its last 12 sessions. Life 360 gained 6.2%. Weebit Nano surged 6.7% on a customer tape-out milestone. Defense stocks caught a lift after President Trump signaled plans to escort neutral tankers through the Strait of Hormuz. Electro Optic systems jumped 6%. DroneShield rose 4.6%. ANZ reversed course after 3 separate broker upgrades following its half-year results, gaining 1.9%. The session's defining feature was a split between the domestic rate-sensitive economy and anything with global or defensive exposure. Housing approval data added to the pessimism. Total dwelling approvals fell 10.5% in March to 17,300, far below the 20,000 monthly pace required to meet the National Housing Accord target. The accumulated shortfall is now a structural drag on the construction sector, and with rate hikes continuing to bite, Commonwealth Bank's economics team is flagging new dwelling cost inflation ahead as supply chains remain disrupted. The housing story threads directly into the consumer spending picture that dominates RBA deliberations. And then there is NAB. National Australia Bank delivered its half-year results on Monday, and the headline number looked soft. Cash earnings came in at $2.64 billion, below forecasts. The shortfall traced to a $949 million after-tax software capitalization charge, which NAB CEO Andrew Arvine described as a one-time accounting shift. Strip that out, and underlying cash earnings were $3.59 billion, up 2.3% on the prior half. But the number that rewrites the session is buried in the balance sheet. Total business loans across NAB surged 11.5% year-on-year to $306 billion. That is not a rounding error. That is the largest business lending book in Australia, and it grew through a period of 3 rate hikes, an oil shock, a Strait of Hormuz blockade, and persistent above-target inflation at 4.6%. Australia's private sector, as NAB's own numbers demonstrate, is in the middle of a borrowing boom. At the same moment, NAB CEO used the results announcement to say that recession is possible, the first time a Big Four chief executive has deployed that word in this cycle. Credit impairment charges rose to $706 million from $485 million in the prior half, a 45% jump. The bank added $300 million in forward-looking provisions, specifically citing potential stress from the Middle East conflict and fuel supply disruptions across key sectors. Management leaned into proprietary home loan drawdowns and SME business lending simultaneously, growing the book while fortifying against the book going bad. This is not contradiction for its own sake. It is 2 distinct signals from the same institution pointing in opposite directions, and both are credible. The business lending boom reflects the lag between rate decisions and credit decisions. Companies that locked in borrowing facilities 6 to 12 months ago are still drawing down. Refinancing timelines mean much of the $306 billion is already committed, not freshly originated. NAB's loan growth in this reading is less a live signal of confidence and more a delayed echo of appetite formed before the third rate hike materialized. The forward provisions are where the bank's real-time view lives. When a lender of NAB size sets aside $300 million specifically for macro scenarios that have not yet materialized, it is pricing in risk that the loan book itself does not yet reflect. The gap between the outstanding loan total and the impairment stack is where the paradox sits. The reversal condition: if the RBA holds after tomorrow, which no major bank currently forecasts, the forward provisions look overcautious, and NAB's loan book expansion reads as justified confidence. That scenario is not zero probability. One AFR piece cited a former RBA official arguing the government could save billions by holding rates this cycle, and The Guardian noted Australia is increasingly the global outlier heading toward a hike while other central banks pause. If Bullock surprises to the hold side, NAB's Tuesday close becomes a very different number.
Forward provisions are not predictions. They are probabilities, specific, quantified bets a bank makes about the distribution of outcomes in its own loan book. When NAB's provisioning jumped 45% in a single half, the bank did not just say things might get harder. It priced a scenario where a meaningful portion of that $306 billion borrowing boom defaults or restructures. The historical parallel is uncomfortable. In the second half of 2007, Australian banks reported record loan growth across business and residential portfolios. Provisions were building, but not fast enough. The gap between loan growth rates and impairment trajectories narrowed sharply over the following 12 months. NAB's current position inverts that sequence slightly. The provisions are being built before visible default stress, which could read as prudent management or as an early indicator that the bank's internal credit models are seeing deterioration that is not yet in the public data. The housing approval collapse reinforces the concern. At 198,396 approvals in the past 12 months, Australia is running at 83% of the annual pace needed to meet the National Housing Accord target. Approvals for apartments and units fell 26% in March alone. Construction cost inflation is accelerating as Middle East supply chain disruptions push materials prices higher. The sectors most exposed to the fuel and freight cost spike, which Endeavour Group quantified at $6 to $8 million in a single quarter for a single company, are also the sectors where NAB holds a dominant business lending share. Victoria's state budget, due Tuesday, adds a fiscal layer. Net debt is forecast to reach $199 billion within 4 years, representing 24.7% of the state economy. Former Commonwealth Bank chief David Murray has raised the prospect of a federal bailout if conditions deteriorate. Victoria is NAB's home market. The fiscal compression expected there, reduced public spending to stabilize the debt trajectory, runs directly counter to the household income support that would allow NAB's business borrowers to maintain their repayment schedules. The verification benchmark for this thesis is NAB's impairment charge in the second half of FY26, due in November. If the $706 million in charges for this half holds or rises, the forward provisions are playing out as modeled. If impairments fall back toward the $485 million level of the prior half, the risk price to NAB's current share price was overcautious. Evidence so far tilts toward the provisions being directionally correct. The rate environment, housing supply crisis, rising construction costs, and a CEO willing to publicly say the word recession suggest the loan book's growth rate and its credit quality are moving in opposite directions. But the lean only holds while Tuesday's RBA decision delivers the expected hike. A hold tomorrow removes the primary transmission mechanism. It relieves the household and business cost pressure that is supposed to convert the loan book's growth into its impairment. The question the market can't answer today is whether Bullock sees the same data NAB does. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.